To give us an insight, joining us on the show is Rakesh Valecha. He's Senior Director for Credit and Market Research at India Ratings. Good morning, Rakesh. Good to have you on the show. You've recently published your report, and it's titled Asset Funding of Top 500 Corporate Borrowers. Now, before I ask you about your observations, I want to ask you first about the reason for this study. Is it because the current economic cycle or credit cycle is shaping up the way it is, or because it's towards the end of an NPA cycle that you're witnessing these trends?
Yes, see, I think we have been looking at this top 500 corporates from a fairly long period of time, and invariably we have been focusing on the cash flow side. And what we realized was that with the kind of, as you rightly said, about the kind of NPAs and the restructured assets, and with some of these new schemes which are coming in, the S4A scheme and all, we thought there was also a need to look at the cash flow in conjunction with the asset quality. And which is where we decided to delve into the real asset quality of the underlying corporates and identify where are the opportunities where some of these schemes may actually work, and where are those cases where the scheme may probably not be as effective as one would want it to be. So I think that was really the driving force behind which the report was kind of commissioned.
Right. One of your observations in the report has also been that non-productive assets are going to raise cash flow recovery concerns. Help us to understand in greater detail as to, and specifically around sectors that are facing these challenges and the quantum of debt which is under stress.
Yes, so I think what we are saying here is that there is a cash flow stress which is visible in the NPA and the restructured assets, which are operating in the system as of today. Within that, what we are trying to say is marry it with the asset quality. And by asset quality, what I mean to say is, when companies have raised debt over the last 5 to 6 years, how has been the utilization of the debt? Has that debt actually gone into building up incremental fixed assets or working capital? Or has it actually gone into building up financial assets? Some of this may actually be non-productive in nature. So we've kind of combined the two together and said, okay, if there is a cash flow stress and you have non-productive assets built in, then the chances of recoveries in those kind of assets would tend to be fairly low. Whereas if you have strong cash flows and you have weak assets as well, while presently some of these companies may be doing well, but because of the weaker assets, you may realistically have a challenge if they were to raise more and more debt. And on the other side, you probably have a situation where you have strong assets, a strong quality of assets and weak cash flows. So potentially these are the cases where banks will identify opportunities to turn these around over the period of next few years, and some of the schemes like the S4A would probably fit into these kind of companies. So I think it just gives you the options where to focus your energy on, where to focus your attention to, and which are the ones which are more viable and likely to give you positive results over the next few years, and which are the ones which would continue to surprise you on the negative side, even despite doing whatever best you can do by way of restructuring. Coming to your point on the sectors per se, yes, we have identified the sectors as part of this exercise as well. And what we realized was the ones which have cash flow problem as well as asset quality issues, those are by and large concentrated in sectors like infrastructure and construction. You have sugar, you have consumer durables, you have trading, you have airlines. I think these are sectors which continue to remain challenging and would continue to do so going forward. The sectors where there are opportunities, where today presently the cash flows are stressed, but we think the quality of assets is reasonably good, or at least reasonably decent as compared to some of the other assets, are sectors like oil and gas, metals and mining, power and textile. So this is where I think the opportunity for turning around under the S4A scheme will probably work better as we go along. And some of the sectors which continue to do well, which have both good quality assets as well as the cash flow strength, are sectors like cement, pharmaceutical, auto and auto ancillary, chemicals. So I think that's how the sectoral distribution kind of pans out.
Right. You've also mentioned that the metal sector has gone through a structural change. Now, has the sector overall been able to invest in more productive assets over the last few years? And what's the current health of that space?
Yeah, so I think if you look at it, so for example, as you mentioned, the metals and mining sector, so obviously that's a sector which has gone through a structural change in terms of the cash flows that it has been generating. So, the cash flows are definitely much lower than the kind of debt levels that you would have raised in the last few years. So there is definitely a challenge in terms of servicing that debt level compared to what would have been originally anticipated and what the companies are today generating. So there is a cash flow stress which is visible in the metals and mining space. Obviously, that seems to have improved in the last 1 year, especially after the MIP scheme came in for the steel sector. What we're trying to say is, while there is a certain amount of stress here, if I look at the last 5 to 6 years data for the metals and mining space, what we found was that the companies who have raised debt in this particular sector have by and large used it for productive assets. When I say productive assets, they have by and large built up fixed assets or have used it for their working capital requirements, which means that while there would still be some amount of haircuts required to kind of correct the capital structure, but as soon as these haircuts are put in place, it's highly possible, because of the presence of large productive assets, you are able to turn around these assets over the next few years. So I think that's the message that we are trying to convey. Obviously, within the space, you have the pressure is much more visible into the mid to smaller kind of entities in the steel sector. Definitely, you probably have the larger ones which still continue to do well, have more liquidity available with them. But I think across the board, I think the finding tells us that the assets have been much more productively built compared to some of the other sectors where actually financial assets were much more dominant.
Right. You've also highlighted engineering, media and entertainment, trading as one of those sectors which have been able to fund higher return generating assets. So should our viewers see these as outperforming sectors going ahead from here on?
Yeah, that's right. So I think what we're saying is, yes, if you have more productive assets, or even if you have financial assets which are return generating and have been built from funding through your profits or through your equity, I think the chances of recovery would tend to be much better over the next few years. Again, not to say the fact that some of these assets are so deeply impaired in terms of cash flows, you will still need some kind of haircuts, but those would tend to be much lower. Whereas for sectors which are, as you said, media, entertainment, where they've actually invested in financial assets per se, that's not necessarily too bad, as long as you're making profits and investing in financial assets which are generating returns, and probably that's a better option to invest. I think some of these sectors, given the quality of their assets, would turn around faster than the ones which have weaker quality assets.
Right. To name some more spaces and sectors, you've named airlines, consumers, food, shipping, retail, IT and telecom as few sectors where debt has not been used for productive assets. What's your view around these?
Yeah, so I think while we obviously don't comment on stock market returns, I think when we look at it purely from a return on capital employed versus the weighted average cost of capital that we are trying to compare with, some of the sectors that you mentioned where investments have not necessarily been kind of put into productive assets or have gone into investments which are probably not return generating in a meaningful form, I think those would continue to probably provide some disappointment as far as the returns are concerned compared to the weighted average cost of capital. And in some of these sectors, probably you will continue to see a situation where the returns are actually lower than the weighted average and continue to drain shareholders' return as well as impact debt servicing as well.
All right, let's also focus a little more on the IT sector, since that has clearly been the focal point very recently. Was there anything that you found concerning in the mid-sized category or large category in the IT pack?
I think it's very difficult to say that, and you would not actually find too many of the IT companies in the top 500 borrowers in the first place. IT companies tend to be relatively low in terms of, at least the borrowings tend to be relatively lower. So I think that would be a very small constituent of the overall universe. So I'm not sure whether it will make sense to kind of extrapolate whatever we may have kind of concluded in this report to the larger basket of IT companies. So I think it's by and large restricted to the borrowers, the top 500 borrowers, and IT companies don't necessarily fall into the category of large borrowers.
Right. Also take us through some of your observations around increasing investments in related parties and financial assets.
So I think what we're just highlighting here again is the proportion of assets which can give you certainty of returns. So if you have if the companies have more productive assets, I think the certainty of returns probably becomes a bit more visible, especially when the economic cycle picks up. You can visualize to what extent the companies can recover. But entities which have a larger proportion of financial assets on their balance sheet, I think it just creates a bit a level of uncertainty, both in terms of returns as well as in terms of recovering the amount that has been invested. A number of companies, especially in the risky category, for example, may have invested in or provided loans and advances to related parties, or may have invested in the unquoted equity shares of some of these group companies. Now, it's probably very difficult to say what kind of returns they would get, and I think the key question also is whether they will actually get the money back. So when you create that uncertainty in terms of returns as well as in terms of the principal recovery, that I think is what really builds up and shows itself in the overall strength of the balance sheet. I think that's the concern that we are trying to highlight, and especially if a lot of that has been funded by debt, it just aggravates the problem in a situation where cash flows are stressed, and as and when the recovery happens, you are not able to take full advantage of that.
Right. Your report also is interesting from the standpoint of an earnings trajectory going ahead from here on. Can you take us through how you see earnings growth, and linked to the kind of debt exposure many of these corporates have?
Yeah, so I think the way I would try to highlight the three key messages from this report is, as you rightly said, one is the productive assets are still a reasonably large proportion. That's about 23 trillion out of the total debt of about 30 trillion. So that's the good news. I think the challenge is that out of the 7 trillion that you have, which is unproductive in nature, about 4 trillion of that is something which is held by companies which are already stressed with their cash flows. So I think that's the one bucket where, for example, stressed cash flows with weak quality of assets, the recovery is going to be fairly challenging, and the possibilities of kind of reviving these companies may become really kind of difficult. The other is some of the entities which have unproductive assets, so the balance 3.4 trillion out of the 7.4 also are held by some of the stronger cash flow entities. When I say stronger cash flow entities, while these are reasonably well positioned today because of stability in their cash flows, but also because of maybe support from their sponsors, I think these are the entities one needs to be very, very cautious of and very careful of. So while today they are continuing to perform well, I think one would have to watch out that if they do kind of build up further debt on their balance sheet, I think these could kind of create a bit more challenge. And the last point I would like to highlight is that within the stressed entities, especially sectors like metals and mining, power and oil and gas, some of them, I think there is a reasonable chance that these productive assets would actually turn around at some stage, although you will again require some haircuts. But despite the cash flow stress, the presence of productive assets will help banks kind of revive some of these assets and make them viable over the next 3 to 4 years.
All right, Rakesh, we leave it at that, but appreciate you joining us with highlighting the contours of your report and also stressing on different sectors and clearly giving an outlook as well in terms of earnings trajectory going ahead. Well, let's move on now and let's focus on